Hi. For this slide, we will learn about source of financing. To fund businesses' growth, it may be done through several ways. Additional funds may be required for capital asset acquirement, as the development of new products can be very costly. The sources of fund can be raised through various sources. We will learn the so-called sources. At the end of this topic, you should be able to identify the need of long-term and short-term financing, and able to discuss the benefits of long-term and short-term financing. There are 3 types of sources of financing: long-terms, short-term and private fund initiatives. Long-term source of financing divided into 2, equity and debt. Equity can be classified into 3, ordinary shares, preference shares and warrant. On the other hand, debt can be classified into 4, debentures, lease, hire purchase and government assistance. For short-term source of financing, it also can be divided into 2, internal and external. Internal can be classified into 4, owner's investment, retained profit, debt collection and sales of stocks or assets. External source of financing can be classified into 3, short-term loan, trade credit and bank overdraft. For this slide we will look into long-term source of financing. An ordinary share is the common way used by every company in order to raising their capital. Shown are characteristics of ordinary share. Every company has their own authorized capital that has been registered during the incorporation of company. It indicates the maximum number of shares that can be issued by the company to the person who interested to become the owner of the company. The people who buy the share of the company will be called as shareholder and considered as one of the owner. Ordinary share is also called as common stock. The person who interested to become the owner of the company will buy the ordinary shares. It works when the shareholder was entitled to have the right to vote, especially during the general meeting. This shows the power of shareholder who have a significant number of ordinary shares. If a shareholder failed or do not attend to the general meeting for the voting purpose, the voting can be cast by proxy or cast by someone who become on behalf of that shareholder. Rate of dividend for ordinary share is not fixed. It shows that the ordinary shareholders need to face high risk if the company suffer losses and unable to give return to them, as well as they can lose their capital. Every shareholder is entitled to receive and being communicates to any information that is appropriate to be received by them. It includes audited annual reports of the company for each year, the minutes of the meetings of the board of directors and the list of shareholders. Ordinary share is categorized as high risk, as last party to claim in case of bankruptcy, as all companies' obligations must be paid first. But it is also high reward, as capital gain or dividend received when company making profits. Ordinary shareholders also entitled to share in the profits of dividends only after dividends have been paid to other classes of shares. A second type of stock, which a company may choose to issue, is preference share. Preference share is listed separately from common stock and trades at a different price. Characteristics of preference shares are as shown. Preference stock shareholders typically do not hold any voting rights, opposed to ordinary stock shareholders which usually do. Preference stock shareholders does have a claim priority over ordinary stock shareholders in the event of company's bankruptcy. Preference shareholders enjoy priority first in the payment of profits and dividend. It promises the shareholders with a fixed dividend, both when the business is operating, and also in the event of a company entering into liquidation in the future. However, they are not paid first since the company needs to pay off the liabilities. But they get paid off before the ordinary stockholders. Type of payments for preference shares are cumulative payment, fixed payments and preference rights. Shown a type of preference shares. Cumulative preference share makes the holders entitled to receive fixed dividend for every year. If the company has difficulty to pay a dividend, it will be carried forward and the amount will be accumulating from the first year. Non-cumulative preference share makes the dividend received by the holder is still in a fixed rate, only when the company has ability to pay dividend out of profits. When the company do not have sufficient profits to pay a dividend, the dividend cannot be accumulated and cannot be carried forward to the next financial year. In participating preference share, the holders still received a fixed amount of dividend and in addition to be allowed to participate for another additional dividend that already stated in Articles of Association. The additional dividend only will be given after all of the other classes of shareholders have received their dividends. The holders of non-participating preference share are not allowed to participate in receiving any additional dividend even after have a surplus amount after allocating dividend to all classes of shareholders. Redeemable preferred stock is a type of preferred stock that allows the issuer to buy back the stock at a certain price and retire it, thereby converting the stock to treasury stock. These terms work well for the issuer of the stock, since the entity can eliminate equity if it becomes too expensive. The redemption feature tends to set an upper limit on the market price of the stock, since there is little point in bidding the price of a share above its redemption price. In future, the holders are entitled to convert its convertible preference share to ordinary share as stated in Articles of Association. The time and rate of conversion will be specified by the company, and the holders will experience the same advantages as ordinary shareholders. Next source of financing in equity class is warrant. Warrant is a derivative instrument that gives its holder the right to buy a given quantity of the underlying shares at a predetermined price or exercise price on or before a particular date or expiry date. Warrants are issued and guaranteed by the company, and entitles holder to buy the underlying stock of the issuing company at a fixed price called exercise price until the expiry date. Holders have to exercise the right before owning the stock. Warrants also are frequently attached to bonds or preferred stock as a sweetener, allowing the issuer to pay lower interest rates or dividends. They can be used to enhance the yield of the bond and make them more attractive to potential buyers. There is no accounting entries for warrant, but memorandum of account will be maintained. Holders can either exercise his right to buy the company's share at the exercise price, or sell the warrant in the open market. There are two types of warrants, put warrants and call warrants. Both put and call warrants are classified by their exercise style. Call warrant defined as a specific number of shares that can be purchased from the issuer at a specific price, on or before a certain date. Put warrant defined as a certain amount of equity that can be sold back to the issuer at a specified price, on or before a stated date. Companies may issue a series of warrants whenever investor demand is insufficient. Each series may have different conditions and prices, allowing companies to promote a new, more favorable warrant over a previous series that is no longer appealing to investors. Warrants are attractive when the warrant's in the money. Warrants are in the money when the warrant price times the conversion rate plus the exercise price is lower than the underlying share price. However, warrants are less attractive when out of money when the price times the conversion rate plus the exercise price is higher than the underlying share price. There are two types of warrants, put warrants and call warrants. Both put and call warrants are classified by their exercise style. Call warrant defined as a specific number of shares that can be purchased from the issuer at a specific price, on or before a certain date. Put warrant defined as a certain amount of equity that can be sold back to the issuer at a specified price, on or before a stated date. Companies may issue a series of warrants whenever investor demand is insufficient. Each series may have different conditions and prices, allowing companies to promote a new, more favorable warrant over a previous series that is no longer appealing to investors. Warrants are attractive when the warrant's in the money. Warrants are in the money when the warrant price times the conversion rate plus the exercise price is lower than the underlying share price. However, warrants are less attractive when out of money when the price times the conversion rate plus the exercise price is higher than the underlying share price. Reasons for warrant issuance are shown. Warrant issued by company for sweetening debt. Warrants attached to debt offering provide a feature whereby investors can participate in capital gains while doing debt. Attaching warrants to long-term debt is a sweetener, performing essentially the same function that the convertibility feature on debt performs, that is, giving investors something they want and thereby increasing the marketability and demand for the bond. Warrant flexibility also is one of the reasons why companies issue a warrant. Warrants are exempt from guidelines regarding exercise price and date of maturity, and they do not have to meet any rules regarding the size of the contracts. This means that companies may issue a series of warrants whenever investor demand is sufficient. Each series may have different conditions and prices, allowing companies to promote a new, more favorable warrant over a previous series that is no longer appealing to investors. Warrant issuance might be potentially attractive to small investor. Investors may purchase warrants for a fraction of the cost of the stock. During the lifetime of the warrant, if the share price increases, the investor may buy the stock at the point that maximizes his profit. The most the investor stands to lose is the amount paid for the premium. The low cost and low level of risk make warrants attractive to investors who are willing to risk only a limited amount of cash. Lastly, warrant holders are not stockholders. Warrant holders are not eligible for dividends and they have no shareholder voting rights. The duration for a warrant series is typically several years, throughout which the company has the use of money paid for the premium without significant liability for unexercised warrants. Okay. Thank you. Head to next slide, debt as source of financing in long-term category.